The housing market just took another hit. First, it was mortgage rates passing 7%, and then the Federal Reserve Bank just raised interest rates again. At the same time, home prices have started to come down, but not fast enough to make up for the higher cost of borrowing. According to Reuters, home prices will fall by 4.5% in 2023. Let's run with the number though. That means that this home back in January of 2023 would cost you, say, $300,000. And if you put 10% down, that means you'd be borrowing $270,000. Now, in the beginning of the year, when we saw that little slump in mortgage rates, you might have been able to get a 30-year fixed rate mortgage for around 6%, which means that your monthly payment on this $270,000 that you're borrowing is $1,600 a month. Now, fast forward to the end of 2023 December, where Reuters says home prices will fall by 4.5%, which means that this home would fall from $300,000 to $285,000. Now, if you put down the same 10%, that means you're going to be borrowing $257,000. Now, if we stick with the assumption that mortgage rates are going to be higher at the end of the year than in the beginning of the year, now, let's see what that means, because if mortgage rates go to 7% and stay at 7% at the end of the year, that means that now your monthly payment on this less dollars would be $1,700 a month. You still have to pay more money even though you're borrowing less because the interest rates are higher. And this is assuming a 7% mortgage. If mortgage rates are, say, 8% at the end of the year, maybe the Federal Reserve Bank continues to raise interest rates, maybe inflation stays high because inflation also has an impact on mortgage rates because inflation will impact treasury bonds, which will also push up mortgage rates. But if mortgage rates go up to 8%, that means that now your monthly payment is going to go up to $1,860 a month, even though the home price is less. For you to buy this home and pay $1,600 a month at a 7% mortgage, that would mean that home prices would have to fall by 11% from January to whenever you buy the home at 7% for you to pay $1,600 a month, and for you to get this home at an 8% mortgage and pay $1,600 a month, that means home prices would have to fall by 20% from this January high. By the way, in case you're wondering what that means in dollar terms, this $300,000 home would have to sell for $267,000 at a 7% mortgage for a mortgage to fall to $1,600 a month, and with an 8% mortgage, it would have to fall to $243,000. This brings us to the question of where interest rates will go. Now, we've been covering this pretty extensively in Market Briefs, which is my free financial newsletter where every day my team is breaking down what's happening in the housing market, the economy, the stock market, crypto, and the global economy into a fun, witty, and easy to read email. If you haven't joined Market Briefs yet, I highly recommend you do so because it's packed with content, valuable content, and it's completely free. So if you haven't joined Market Briefs, I got that link for you down in the description below. There are two main factors that will determine where mortgage rates are going. Number one is the interest rate set by the Federal Reserve Bank, and number two is inflation. Now, if we start by talking about the interest rate set by the Federal Reserve Bank, the Federal Reserve Bank is the central bank here in the United States, and they essentially set the wholesale rate for loans, aka when banks lend money to each other, this is the rate by the Federal Reserve Bank. So you can think of it like the wholesale price. Banks have to borrow money at a certain price, then they jack it up and give you the retail price, which is the mortgage rate. And recently, the Federal Reserve Bank raised interest rates by 0.25%, and they hinted that they will be willing to raise interest rates more, but they weren't as aggressive on this whole idea of continuing to raise interest rates a lot more in the future. So I would put a question mark on how much more interest rate hikes we're going to get by the Federal Reserve Bank, and this is going to vary depending on what happens in the economy, what happens with banking, what happens with layoffs. But there is a good chance that the Fed will continue to raise interest rates at least a little bit more. The second factor that influences mortgage rates are inflation, because when you have high inflation, that pushes treasury yields higher. A treasury yield is when you loan money to the government, and when people are worried about inflation, the government has to incentivize you with higher interest rates to loan money to the government. This is considered the risk-free rate. When you loan money to the government, it's considered a risk-free investment, and as you have high inflation, the risk-free rate, this interest rate continues to rise. When the risk-free rate rises, it also pushes mortgage rates higher, because when you lend money as an investor into the mortgage market, well, you would expect a higher return than compared to the risk-free rate. So high inflation pushes treasury yields higher, which also pushes mortgage yields higher. Now, we still have high inflation today. Where will inflation go? Well, I guess time will tell, but The Federal Reserve Bank will need to keep raising interest rates to bring inflation down. If the Fed slows down their interest rate hikes, that could push inflation higher, which would also push Treasury yields higher. Now, there's a lot of different opinions about why we have inflation and where inflation's going. Here's one opinion on inflation.
Today versus 18 months ago, the price of the same house for your mortgage payment is twice as high. Why? Because of the runaway spending.
Now you can compare that with this opinion on inflation.
And there's a pile of data showing that price gouging and supply chain kinks and the war in Ukraine are driving up prices. You cling to the idea that there's only one solution: lay off millions of workers.
Inflation comes from the word inflate. When you have inflation, you're inflating the monetary supply, meaning you're increasing the amount of dollars out there, which increases demand. Because now if people have more money, you have the ability to spend more. And if you have the ability to spend more, now you can go to the mall and buy more stuff. If you can go to the mall and buy more stuff, now businesses have to produce more stuff, but they're limited in their capacity. They're limited in their ability to produce. And if they don't have the ability to produce, well, that forces the price of things to rise, because now you have more people buying than they can actually produce, more demand than supply. This forces prices up, which then results in inflation, because now people want more money. It costs more money to get materials. It costs more money to produce things. So more money out there causes more inflation. Now, in order to bring inflation down, you have to do the opposite, which caused the inflation, which means you have to get the money out of the economy. One way that the Federal Reserve Bank does that is by raising interest rates. Because when you raise interest rates, you make borrowing money more expensive, which makes less people interested in borrowing money, which cools down demand, because that means less people are spending. And if less people are spending, that also cools down the economy. Take a look. Now, what you have to understand is that there are consequences to cooling the economy off. Notably, unemployment levels would rise. Take a look.
You're raising interest rates. You're raising interest rates to slow the economy, are you not?
Yes, to cool the economy off.
In order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
See, the layoffs aren't necessarily the goal with higher interest rates. They're more of a byproduct of higher interest rates, because higher interest rates cool the economy off, which means businesses make less money, which means that businesses have to let people go. So it's the consequence of the cooling down of the economy. Now, how much more aggressive will the Federal Reserve Bank be to bring inflation down? And how much more cooling will we see in the economy? And how long will inflation stay high? Well, only time will tell, but what I predict is that inflation is going to be around, and unless the Federal Reserve Bank stays aggressive to bring inflation down, it's going to continue to linger. High inflation will cause more pain in the economy, because inflation by itself hurts the middle class, it hurts people's spending ability, and it also hurts people's ability to be able to buy things like a home. So it looks like inflation is going to still be around. It looks like the Fed will continue to raise interest rates, which means that we'll probably see more pain in the economy, which also hurts people's ability to buy a home, because, well, if the economy is suffering, people have less ability to spend. So understand that economic pain and housing market pain kind of go hand in hand. It's a little bit different than 2008, because when the 2008 crash happened, it was a domino that was started by the housing market, which then trickled out to other parts of the economy. Now it's inflation, which will trickle down to the economy, which could trickle down to the housing market. And when will the economic pain stop? Well, only time will tell, but this is why you want to pay attention to the Federal Reserve Bank. You want to pay attention to inflation, and you want to pay attention to what's happening in the economy, because all three of these things are tied in together. And right now, as of the time when we're recording this video and releasing this video, we still have high inflation. Interest rates will have to go higher, and the economy is cooling, which means we have this like triangle of things coming together that you need to pay attention to, because this will have an impact on the way that our economy works. And of course, we'll be keeping you posted on market briefs, which is why if you haven't joined yet, make sure you do that. Our money, or at least what we call money, is being put to the test, not because of inflation, not because of interest rates, but because of something called debt monetization. Let me explain. Our government doesn't earn money. It collects money through taxes by taxing people like you and me. And in 2022, the government generated about $5 trillion